Welcome back. If you remove one line from the banking sector performances, you'll find that growth was still marginal. I'm told that some of those books need to be normalized for us to know if the accounts are, if the stocks are really performing, growing, or it's just a book provision, an expense that has been restored. Perhaps we are continuing with the banking sector, and I'm here with Willis. Let's start with KCB Bank. It looks like its strategy has been to go regional. The other day it wanted a bank in, I think it's DRC Congo, and regulation didn't work in its favor. In Kenya it has already bought NBK. Looks like its expansion is in terms of acquisitions and mergers with other smaller banks. Is this really paying off in their books?
It is paying off. We've seen that when they're going regional, there are strategic issues that they're trying to settle or to improve on. Most of it has been going to countries that have very good forex income. That's the strategy that they use, and the two leading banks have used in the region. So countries that have very good, and then the countries that have low penetration in terms of financial sector. If you look at it, the entry into DRC still has a very vast majority who are not banked. They still have a very large public service sector that again hasn't been covered or has not been tapped in terms of fully. Those are some of the countries that have digital space to enter and do digital lending or digital transactions. So they still have space in these countries. So they're just trying to enter the markets that they know they have a strategic advantage, whether it's vis-a-vis the small banks that are in those countries, or they can present a very good platform for that. Again, last time we were here, I told you that most of these companies are using their Kenyan platform for the operations. They perfected the operation system, whether it's credit, whether it's IT, which is being run centrally. So
it's like the model being replicated.
Yes, so that model will be able to manage costs in these countries and be able to push the bottom line upwards from the current levels.
But I hear that some of these subsidiaries are making 100 million, something that, you know, at the whole country subsidiary, something that a branch in Kenya can make. Actually, perhaps the Kibera branch of KCB is making that 100 million, because Kencom would probably make a lot more. Is it then material to really invest in some of these areas?
Look at it at different perspective. Maybe we need to look at the strategic reason as to why they've entered there. And one of the, maybe we can just front run to maybe Equity. Equity, when they entered DRC, they are very vocal, very loud in terms of what they're able to provide in the market there. They might not, it might be a branch performance in terms of transaction, but remember, if you're a Kenyan trader doing business in DRC with your account in Kenya, then that's money that you still bring into Equity Bank in Kenya, but instead of DRC. So what we've seen is that even the regional business platform, with Kenya being one of the largest exporters, or what we call transit export in the region, then any person who's doing business and has a bank in Kenya, whether it's Kenyan who's doing business in the region or a regional business person who transacts in Kenya, then they have one bank across the board. That is something that you cannot price in your what do you call
in the books.
In the books. But the moment that you facilitate this person, that means you've locked it, or you've locked him in, and you're able to milk him as much as possible in terms of any revenue.
That's how KCB locked us in our firm. So I agree that is true. Yes. The challenge now becomes that it is such a qualitative benefit that you cannot put it in the P&L and actually report that we locked in Ramogi and his company.
Over a period of time, you will tend to see it repay. Remember that the initial cost will be high, but the moment you continue trading and you take a loan in Kenya to do business in Rwanda or DRC, then you tend to have two different revenue platforms for this bank. So over a period of time, you will tend to see it grow. But unfortunately, again, KCB and Equity Bank Kenya performs very, very well to overshadow these other sectors. Kenya has a very good financial platform. So if you're trying to compare how they perform in Kenya vis-a-vis these other countries, then you might not see their vision as per se.
Yeah.
Again, KCB Kenya did about 118%, with the group doing 107% in terms of performance growth. So you will see that if you remove the subsidiaries, the Kenyan bank itself did very, very well. But now when you create the benefits that this client are able to retrieve, if you're able to create the finer revenue lines that these banks retrieve from these regions, then you'll see the advantage of the regional bank. And again, Ramogi, please note that it's not only Kenyan banks that are struggling in other regions. Other regions that are operating in Kenya, other bank regions that are operating in Kenya are lagging in their Kenyan branches. We have EcoBank, which if you look at the Kenyan unit vis-a-vis their global unit, Kenya unit is a very small, it's a branch, for example, compared to Togo.
But you know, buy Kenya, build Kenya, we are more inclined towards that direction.
So those are the images. That is a mirror image that you see a Kenyan bank having that in a different region compared, and again, a regional bank having the effect in Kenya. You cannot, it's very hard for you to come from foreign market and dominate the local market.
So there is the homeboy effect.
Yes, that's a very big factor. Yes.
Let's talk about Equity Bank. It looks like their strategy is horizontal growth. They want to go into other sectors. And from what I observed the other day, they have gotten license to operate an insurance company, life insurance for that matter. And before that, of course, they had gone into the telecommunication space. What do you make of this? Is this, isn't it a bit too risky?
No, it's not a risk.
On the contrary, it's spreading the risk.
It's spreading the risk. Remember, it's also a revenue generating factor. Right now, Equity Bank, before that, they had a bank assurance unit. Bank assurance unit has a commission-based agreement with the insurance company who are their underwriters. Then they just take the business and pass it to the underwriter. So the underwriter books the premium. Now,
so who is the underwriter in this case for the bank assurance?
The insurance companies. We have the Britam, the CICs, and the likes.
So you are saying there are several underwriters that underwrite for Equity Bank?
No, I'm saying there are several underwriters underwriting for Equity Bank assurance business.
Fair enough. That's exactly what I wanted to hear. Because now I am concerned that Equity Bank will get equity insurance, or whatever it is called right now, and equity insurance to underwrite for Equity Bank assurance. That is too much risk in one basket.
No, it's not. Remember that whether you transfer that risk to another different company or manage it, you're still covered. Now, let me give you a breakdown on what happens. So, for example, Equity Bank Assurance gets the premium from credit insurance for the bank. The bank has is approaching a 500 billion book level.
Yes.
So that loan itself, if it's going to be priced through the bank assurance, they have to give the premiums to a different underwriter.
Yes.
Now they are going to underwrite that business themselves. That means they are going to book the premium into the line of the insurance company.
Correct. So but it is still under the same group.
Yes. So they've retained the premiums. So what is the risk level of that particular? And that's the reason why they went for life. Life pays very well. Life business is a profitable business. One of the biggest challenges is the general insurance line, which normally tends to have what we call a negative business model.
A return.
So if they're going to book that life, remember that at the end of the day, if nobody makes claims against the loans, then they book the full premium as revenue. So it's not a risk business. It's just that they've increased their revenue line by one. And again, any insurance company that does life insurance, their reinsurance levels is about 10%. That's how confident they are in the life business. Look at the like of Britam, look at the like of CSC, which are the biggest market players. You know that their life business is more self-insured than reinsured. So if equity business goes to that space, then they'll take the risk and reap all the benefit.
I hear you. That still gives me the chills, but I hear you. Years later, Equity Bank still have the tag of State Bank because government agencies do a lot of business with them. Is this a risk factor in the short to long term?
No, it's not a risk factor. Most of these businesses are, they have agreements, and it's not limited to one entities. If you look at most companies, and when you look at the bankers, you'll see that they have several banks. They don't have one bank, like you try to perceive. No, it doesn't. Equity Bank has been able to diversify into different markets. If you look at the institutional banking, it's just one line on their corporate book.
How big is it?
Personally, I cannot tell you that because they've never shown how much it is. It's an internal formula that they use.
I think I'll have to have a conversation with Equity Bank.
Yes. So that institutional banking is just a one department in their corporate line book. So that risk is not as you're trying to perceive. And the risk, remember there was a time when people were saying that any bank that is holding government money needs to take it back to the government-owned banks, the like of Consolidated Bank. That has never materialized. Why are they able to manage that market very well for them? Maybe just leaving it to the other banks who are able to perceive the risk and contain that better might be the right thing to do. The like of Equity Bank, the like of KCB Bank, the like of Cooperative Bank. So them holding government businesses is not as much risk as it is. Yeah. Again, remember that the reason why these most institutions tend to have an agreement with banks so that they can have a benefit for their staff members, whether it's mortgage or staff loans, which are lowly priced. So that is also a risk that these big banks are taking. So it's not only that they're doing business in one direction, they're also providing services to some of these organizations on the same time.
And so there are indeed associated benefits.
Yes, it is.
All right. I still feel that perhaps the coming elections might affect the so-called banks that do business with government. Is it possible that maybe a new regime will decide to work with, let's say, maybe ABSA as opposed to this other bank, or one bank as opposed to two?
The reality of that, we'll just have to wait and see which direction the government will take in terms of that.
So that's a polite corporate way of telling me there is that possibility and it's a risk factor.
I am not acknowledging that, but if you look at the banks that do business very well with banks, you'll tend to note that NBK is one of the biggest players in that line. NBK is one of the biggest players. So do you want to say that the regime changes, then NBK is going to suffer? No. If you look at, again, the likes of Development Bank.
But NBK has already suffered even without the change in regime.
Yes, so you see, when you call the change in regime, they're different. We always tend to adjust to the regime that is there, whether it's business or you will tend to adjust because it's either you adjust or you suffer. It's either you adjust or you suffer. So the best thing for any business, and I'm not talking about banking here, I'm talking about any business, whether it's the cigarettes, whether it's the breweries, any business will have to adjust to the current regime.
All right. I have 5 more minutes, and I wanted to talk about NCBA. They got the tag of the digital bank, you know, when they partnered with Safaricom for the M-Shwari business, and I don't know if this is still working for them, considering the fact that they have lost market share. When I looked at their books for late last year, they've significantly lost their market share from around 11% to 9%. Yet they are the digital bank at a time when...
Are you talking the banking industry market share, or are you talking about the digital?
The banking industry.
No, the digital, they're still #1. They run about 70% of the total digital market, so they haven't lost that market share. Absolutely. In fact, it's growing. Remember that Safaricom came up with a new product. Okay, it's not a new product anymore. They have Fuliza.
Fuliza and NCBA or KCB?
NCBA and KCB. So there are 3 partners. There is Safaricom, NCBA, and KCB.
Right.
So those are the new products that, okay, it's not a new product. Those are products that are going to push those market share on. So if you're looking at the digital aspect of the banking, M-Shwari is still the market leader, whichever direction you're looking at. They have about 70% market share. So they'll continue to grow. The only difference is that when
that's M-Shwari or Fuliza?
I'm talking about M-Shwari. I'm talking about M-Shwari. Leave alone Fuliza. Fuliza, it hasn't grown the way it's supposed to grow. It's still growing.
Okay.
You and I might be having M-Shwari, but we don't have Fuliza. And it's very rare to have Fuliza and you don't have M-Shwari. It's a mathematical
They go together.
But when you're looking at the digital lending market, it's growing M-Shwari is still the market leader, and it's still trying to capture. It's still capturing other smaller players in the market. The only difference what happened is that last year they decided to clean out their books, remove the defaulters, and those who were good payers, they increased their margins. The lending, the borrowing ability. For those who had bad books, they were blocked out and removed them from that. So that reduced their total market share, but still leaders in the market with that clean. And remember that there's no digital lender who does not have defaulters. In fact, most digital lenders tend to have about 21 to 25% defaulters.
And that includes NCBA?
Yes.
If you are to be asked in these 2 or 3 minutes remaining, perhaps to identify a banking stock that that captures your attention for this season, which one would it be and why?
Right now, if you're looking at the banking sector, then you look at what you call the dividend yield. Who's giving you the highest dividend vis-a-vis the price you pay for that stock? If KCB gives you 3.5 shillings and they're costing you 45 shillings, then that's a lower dividend yield. So if you're going to look at the dividend yield, that's the return on your dividend, then I will pick 2 banks. One of them being Absa at 11 shillings, and they give you approximately 1.1. They did last time. Then that's 10%.
That's 10%
dividend yield. The other one will be Cooperative Bank. Cooperative Bank last year they gave about 1 shillings over the price that was going about 13 shillings. Then that's a very good dividend yield. It comes to about it's about 8.7 something percent.
Yeah.
So if that is how we look at the return. If you're looking at a bank that costs you, for example, 100 shillings and they're giving you 2 or 3 shillings dividend, then that, and remember, like I said, we are going into the reporting period. So right now, if you buy, look at the stock that will give you the highest dividend
yield.
Yes.
Dividend yield it is. Consider it when you're buying your next stock. I was also told that if I am an ethical investor, I should consider BAT because they've already paid the moral tax through the high taxes. It's been a lovely conversation, and I hope you enjoyed it as much as I did. Join us again tomorrow at 4 p.m. for another edition of Markets Today.